Hello traders, Gary Wagner here. It is Thursday, the 18th day of October 2012, approximately 10:30 in Honolulu, making it 3:30 in New York, and this is the daily report for gold and silver. We do have lower pricing across the board in the precious metals markets. As you can see, current print on the screen, 1741.16 and change. Current print in cash gold, down off about $8 to $9 with a low of 1736.90 and a high of 1752.30. Silver also showing signs of decline this morning, actually off almost 1.25% on the day, about 41 cents. As you can see, 32.75 current print with a low of 32.60 and a high of 33.36. Traders, I'm not actually that surprised on a technical basis, that is, to see this lower pricing today. 360-minute chart, straight candlestick format. We'll probably look at this in candlestick as well as Henkin this morning. And as you know, what we are looking at in terms of our current Elliott wave count is that once we actually came in and hit this last high, this was the attempt at 1800. I believe we went into really an ABC correction. A typical ABC correction would be something like this: A, B, and then our final C, wherever that takes us, whether it's a flat, meaning equal, or a zigzag, meaning below that. Now, within that particular count, of course, is going to be a subcount below that. And in terms of the subcount below that, as I said, that might be something like this: 1, 2, 3, 4, and then 5. That would be the completion of our A here, okay? And then we would get our B, or counter wave, and that would be something like a B, and then a C, final C up. And then we would get, of course, our final C down, and that's typically going to be something like a 5 count. So in terms of the area that we're at, and let's go ahead and kind of compress this chart so you can see where this particular count is coming from. This Fibonacci retracement that we're looking at really accounts for the totality of this last rally, considering that the market has moved, I think I've got this pegged at around 1550, 1552. And this would be this long wave 1. And this wave 1 that we're looking at really is a intermediate count within our major count. The major count meaning we're in that final 5th wave, and you're going to have a count of 1 through 5. So you'll get this one, where I believe in corrective stage 2, wherever that takes us. And then we're going to go back into an impulse phase 3. So what does that mean for us? Well, there is a couple of trades that should become available to us. One of those trades is going to be to take advantage of this small upside counter wave. And I call it a counter wave because if we're in a corrective period, these upside moves are counter waves. And that would be if we saw this as our single move here, for example. This is our first of this ABC correction. This would be the B. Now, within the B itself, it should be composed of roughly, and again, this is just Elliott wave modeling, but it roughly should be composed of a 3 count. So that within a 3 count itself, when we take a look at this, and let me now go ahead and blow that back up for us, we might see, again, within this 3 count something like this, where this is our B, we get our first wave up, then this, and because we are really at this 39 area, it is to me a fairly critical area. Close above that would possibly signal this final move up in the B wave. And once again, in terms of a target itself, we have defined our basic area or target itself somewhere between, call it 1760 and 1780. Why? Well, simply what we're looking at is when we do a fib retracement from this last correction, this one wave coming down, our first A wave coming down, your B wave is typically going to be anywhere between, say, 50 and 75% of that move down. And that's why this is your 50 and 75 move right in here. As you can see, this is at 76 because it's a fib number, but nonetheless, it's very, very close. So that one play might in fact be to enter the market from the long side once we have some sort of bottom action or confirmation that we've hit the bottom. And this is an area absolutely to look at, because if it can hold the 1739, which I said is a pretty critical number, and again, when we go ahead and compress this chart, it becomes quite evident as to why it is. You can see that it is a 23% retracement. If that's the case, the first play, of course, would be you've got your 3 count, 1, 2, and then, of course, your third up. And so you would really look to capture the move right in here. And then for those that are short players in the market, there's a possible trade once we see confirmation that this B wave is beginning to run out of steam, is to play that final C, because the final C should take you from wherever it rests back down to about 1739. And as I said, I don't see, even on a steep correction, any kind of breach below or into that low 1700 range. I personally don't see it. Again, I am clouded by the economic and environmental factors out there that I believe have been influencing this bullish move in gold over the last few years, at least since 2008, and they're still present. So for that reason, I don't see really deep cuts, and I don't see that kind of a real correction within the marketplace itself. Now, another way to look at it, and really what the Henkin chart does for me, especially on the short-term studies, is it really clarifies, although it's lagging, but it clarifies for us the waves itself. You can really see a pretty good wave count, and you see it really by the change in color. As we look down, you've got 1, 2, 3, 4, and 5. And you can see they're quite clear. In the same way right now, we have 1, we have 2, and so what we want to look at is the first signs of the market really turning back to green in terms of the Henkin chart as our signal. And that is when I would send out a trade alert. When I saw that dramatic change in terms of the color of the Henkin candle, and it would have to be a minimum of a 240 or a 360-minute chart. Now, traders, we're looking at it. It's a daily chart. It's our gold chart with our current Elliott wave count. And as I said, the only thing when I step back and look at a bigger picture, especially on this daily, and we look at the shallowness of this correction when we consider the kind of move up we've seen here and the shallow amount that it's retraced there, my concern still is we've got these series of tops right in here. Also, this 1699, that 1700 is a very, very strong area. And my sense is that we've gotten close to, but not really touched upon that. And that's why I still think there is the possibility, again, on a technical basis, that we will in fact see this market dip below the 1739 area. But prior to that, I would expect one more counter wave up and then our final C wave down. And that, of course, would be all part and parcel of the intermediate wave 2. Silver. Now, of course, silver has had the ride of a lifetime, and it has gone up so nicely that my real genuine concern is if we go into a standard full-blown corrective action, our next real level of support right now is just below $32 an ounce, $31.82. And I would not be surprised. You can see that we've got effective closes below the 33.16, which was a pretty strong support level. That, of course, is no more. You can see that it's resistance right in here as the market was range bound. You can also see that as the market broke below this one point, this is the 32.82, of course, you can see that it was pretty much straight down until it found support down at about $26 per ounce. But traders, when analyzing silver, we also have to kind of step back and take a look at the big picture, which is why I've basically gone and compressed it. This is the area that we've been focusing on, this one particular range, meaning 38 on the top, 26 on the bottom, with real resistance at 35, and that's right in here. There are other areas that we want to look for in terms of historical references, and over the next couple of days, meaning Friday and then into Monday, I want to start really exploring some of these areas to give us a much clearer or more solvent indication of where this market in fact could go. Because really, when we look at it and we look at it in the big picture, we do have these series of tops right in here. There can be no doubt about that. We also have extreme support down at this triple bottom, same triple bottom we saw in gold. And so the question remains, if we're going to be in a truly bullish manner, we're not going to come in and test these lows again. There's really no need for that. What's more likely, we've got our basic wave here, and this is a intermediate one. We'll get our two. The two will give us some kind of a bounce. It'll be some sort of a three count, as I said, 1, 2, and then 3, wherever it lands, landing at this point. And then we're going to get an intermediate third. Now, the intermediate third, by nature, is going to go over these series of tops here. It has to. It can't be equal. It at least has to take these tops out. But in all seriousness, we would look for a play really back to $38. But that, of course, is once we have technical confirmation that this short correction, and I look at it more as a pullback, that's what I spoke about yesterday, is over. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up. Bye-bye.